Hello, hello, hello. So it's an exciting time. We've got the launch of our Manhattan, New York deal. And, really for me, this is quite a privilege to be able to share this with all of you as investors. It's been quite a year for most of us as investors. And, to really start to finish off this year with some excellent deals is really, really exciting for me, not only to present it to you, but also to be able to invest in it. So I got a question before we get started, and that is, imagine being able to invest in downtown Manhattan and earn a solid return with having your capital protected by a first mortgage debt. So if you're not 100% sure what I'm talking about, just take a step back and just say, imagine being able to invest in Manhattan. So I want to share a story with you to get started. And I went to America in 2010. I've been to America lots of times, but I went to America in 2010 to buy my first properties. I spent 5 weeks traveling around America, and I couldn't find any partners that I could trust. And the information was really quite dodgy. And I sort of felt that, the estate agents, the brokers, the developers would literally sell their sister if they could try and make a sale. That's how desperate they were. So we went back again in 2012 with a different strategy. It was myself, Brendan Brown, and a guy called Neil Peterson from Investor Magazine, Real Estate Investor Magazine. And we did it differently this time. We actually started in San Diego. We did 8 cities in 9 days. And we literally, it was crazy, but in each city we had a partner. So we'd literally spend the day in the city, we'd look at properties all day, and then we'd fly to the next city in the evening, and we'd start again the next morning. So we literally started on the West Coast with San Diego, and we moved our way through Phoenix and ended up in New York at the end. So you can see here, all the different types of properties, the different people we met. There was a lot of chaos on the ground. As Warren Buffett says, when there's blood on the streets, there's opportunity. We made it all the way through to New York, and you can see the New York buildings there on the right-hand side, and then down to Orlando in terms of that process. And we even had some fun in Orlando and went and checked out Disney World. But ultimately, we ended up in New York, and the weather was horrible. It was cold. And, this was me making videos in New York. From there, we came back. So the 31st of May, we did our first event back in South Africa with Real Estate Investor Magazine. We literally told people what we found on the ground. And I think this is really important because at the time, the Rand was 8.52 to the dollar. Now, not everyone that's watching this are South African investors. I get that. But what I'm trying to show is that 10 years ago, the Rand was 8.52, and now it's 19.80. So it's more than halved. Now, if you, in Singapore or in Hong Kong or Australia or, England or wherever, what happened was that you were buying property at half price, and the property's virtually doubled in the last 10 years. And a lot of currencies, not just the Rand, most currencies actually have weakened dramatically against the dollar. So not only did you win on the property values, but you also won on currency. So if you look back at our buyers trips, there's many pictures here. I mean, this is us right out. That's the bull outside the New York Stock Exchange. This was us in New York. It was really freezing in Jersey, opening bank accounts. This is us in Times Square. This is with Dr. Dolph DeRuss in Phoenix, buying properties on auction, meeting the different partners, buying properties, North Dakota, opening bank accounts, buying houses. This was in Memphis, et cetera. So we've got a huge amount of experience of traveling over to America. But what was really interesting is that over time, we evolved this philosophy. And the philosophy was, how do we diversify across countries, currencies, assets, partners, and time? And ultimately, how do we build globally diversified passive income? But our dream was always to invest in Manhattan, New York. Most people understand Manhattan, New York. It's one of the most iconic cities in the world. And we went back, on all those buyers trips, we went 3 or 4 times a year. I probably went to New York 3 or 4 times a year for many years in a row. I've got no idea how many times I've been to New York. And we would always want to buy property in Manhattan, but we could never, ever find property that would make sense. We could never find partners on the ground that could make sense. We could never make the numbers justify. When you're buying a house or a commercial building in Atlanta and it's getting you an 8% cash on cash return or income return, and now in New York, Manhattan, you're getting a 2%. It just doesn't make sense. We then, people look at the icon of the Statue of Liberty. They talk about freedom and everything in between. But what's actually interesting is that where the Statue of Liberty is is on the other side of the river. And this is where you go to Jersey. And so we went to Jersey because a lot of people said, oh, but that's where the deals are in New York. So we went to Jersey, which is on the other side of the river. And we were looking at buildings like this, sort of 3-story walk-ups. And, you know, this was a 4-story walk-up, and we could actually buy this whole building. It was about $750,000, if I remember rightly. And I can't exactly remember. I think it was 4 or 5 apartments. And from the outside, I actually got quite excited. I was like, oh, wow, we finally might have a building. You know, it's a small multifamily. You know, we're buying the building, and obviously there were 4 flats in there at least. I can't remember exactly. And then we went inside, and this was the building inside. And these were the pictures. And I'll never forget, you know, looking at this building and, you know, talking to the partner on the ground, and just, and they literally had a thing in New York where they used to talk about the coin. And, you know, you took a $1 coin, and if it would roll down, you know, that was how bad the floors were, and they had to be renovated. And I remember just thinking, you know, in cities like Florida and Atlanta and Texas and Phoenix, you were buying generally, you know, houses that were only 20, 30 years old tops. And, you know, in New York, you're buying these really old rundown properties. I mean, look at the level of maintenance you had to do. And it was just a nightmare. And we just said, there's just far too much risk. So we never, ever, you know, we looked at a lot of property. We never, ever invested once in New York. What I'm super excited about today is to share with you an opportunity. And, you know, our dream, our philosophy is that if you take a cell phone, you know, we've all got smartphones, we've all got smart watches, we've got smart TVs. So why can't we put smart investing in every single person's pocket? And ultimately, it's about living a life unlimited. And what I'm super excited about today is to share with you the opportunity of how now, by using technology, you can actually invest in Manhattan, New York. Before I go any further, you know, I'm not sharing with you financial advice. Our partners that are joining us tonight are not sharing with you financial advice. I'm merely sharing with you the information about an opportunity plus a partner on the ground and the opportunity they've got, and you need to make your own decisions in terms of your investment criteria. So it's without further ado, and this is the point where, you know, you would beat a drum or you know, play a horn, because it's with a huge amount of excitement that we bring you Catherine Street in Manhattan, New York. And not only is it, you know, certainly the best deal that I've had in many, many years, but more importantly, it's Manhattan, New York. I don't know if you heard me say that. It's Manhattan, New York, probably the most iconic city in the world. And what it is it's a historical rehabilitation of a landmarked Catholic church and school. And I'm going to talk to you about the opportunity. So just before I go any further, most of you all know this, but when we do due diligence, and, you know, I literally wrote the book on this, Clem Santa endorsed this book 10 years ago. We've actually updated it now. So this was Property Going Global. We've actually updated it with a new course 10 years later called Wealth Going Global. But the system that we created in that book, and it's been evolved over time, is GITS, the Global Investment Due Diligence System. And 1.0 is the residential one, and 2.0 is the commercial one. And what you basically do is you look at things from a macro analysis perspective. So you look at which countries do you want to be in. You then look at which cities do you want to be in. You then look at which sectors do you want to be in. Then it's about finding the right partners. Then it's about doing the due diligence on those partners. Then ultimately it's about, you know, the due diligence on the property. And then it's about making sure that you've got the pre-purchase due diligence, etc. Finally, it's about making sure you've got the right type of structures. It's about actually investing in the deal and then managing that deal and maximizing the returns. And finally, it's the overall experience that you've got in terms of your investment, your digital wallets, your returns, etc., etc. So there's 10 different levels. And I want to take you through the mindset tonight of why I'm excited about the Manhattan opportunity. So I don't have time tonight to go into why America, but in simple terms, if you do Wealth Going Global, where we take the, you know, all the countries and we choose the top 5 countries that you should be investing in at a residential level, the top 5 countries that you should be investing in at a commercial level, and the top 5 countries you should be investing in for alternative assets. This is our global property system, which is a graph that I developed with Clem Santa based on his scenario planning methodology. It's a 4-dimensional graph, and it takes into account, if you look on the left-hand side here, you've got return. So it goes from low return to high return. And at the bottom, you've got risk, and it goes from low risk to high risk. Ultimately, you want to be in this top left corner. You want to be in high return, low risk. When it comes to commercial real estate around the world, only America is sitting in high return, low risk. And India is kind of on the fence between high return, low risk, and high return, high risk. So America is the only one that's sort of sitting in that, just on the boundary of high return, low risk. Now, why America? America is one of the most resilient economies in the world. It's probably, come through COVID better than any other country in terms of the process. And look, it's got its problems. There's no doubt about that. But what's also important is that at the moment, it's, the US dollar is the reserve currency. It's one of the strongest currencies in the world. Again, back to Wealth Going Global, if you look, James Painter actually has been talking about the different currencies. And in simple terms, the US dollar is certainly a currency you want to be investing in. So at a macro level, America is where you want to be investing, one of the countries you want to be investing. The US dollar is one of the currencies that you want to be investing in. And then what's interesting is that if you look at the fundamentals from a market summary perspective, so now we start to zone in to New York. And New York has a highly favorable multifamily market dynamics. The economic backdrop of New York is highly favorable for real estate investment. The city's economy has demonstrated a robust post-COVID recovery, GDP growth exceeding the national average, and employment surging, particularly in sectors as professional and business services, leisure and hospitality, education and health services. Manhattan's technology sector, known as Silicon Alley, is flourishing. Rental demand and rents in the city are at record levels, with substantial portion of population being renters and vacancy rates at historical lows. New York occupational rates are amongst the highest in the country. In June 2023, the listed inventory in Manhattan was 10% lower than a decade average in that month. So effectively 10% lower than 10 years ago. The new supply line has not kept up with demand for many years. The shortfall has become more acute over the past 2 years, with completions significantly below the already low long-term average. The result has been minimal increase in rental housing stock. The expiry of the June 2022 421A tax abatement, a critical multifamily developer incentive, has exacerbated the severely supply-constrained market. New permit applications declined 60% in the second half of 2022 in December alone. The year-on-year decline was close to 90%. In 2023 New York State budget cycle, the 421A scheme was not renewed or replaced. And then finally, in a recent report, the Real Estate Board of New York estimates that New York will need to build 560,000 housing units by 2030 to keep up with the expected population and job growth. Between 2010 and 2020, only 185,000 multifamily units were built across the 5 boroughs, approximately half of which were market rate rental units. So if you understand some of the fundamentals of investing, one of the most important fundamentals is supply and demand. And you can already see here that the population is growing, there's a burgeoning demand, and yet there's constrained supply. So again, you've got America, tick, you've got the US dollar, tick, you've got New York in terms of supply and demand, tick in terms of the market fundamentals. Now we go to location. And it's really, really interesting. I don't know how many people know New York, but what I wanted to do here quickly before I go into the location was effectively just to zoom in for you. So this is the exact location of the property. And if you look here, here's where you got the financial district. This here is the Statue of Liberty. On this side, you've got Jersey City. Here you've got Greenwich. If you know the World Trade Center, etc., it's all sitting here. The New York Stock Exchange is literally sitting here. You can see it all popping up. So if I was to zoom out, just to give you a perspective of, there's Central Park. So it's in lower Manhattan, basically. And if I start zooming out, you can get a perspective of New York, and then you can get a perspective of where it is in America. Now, why this is really important. Oops, sorry, where's my slide going? Why this is really, really important is that it's a truly prime location. It's situated in the heart of Manhattan. This property benefits by exceptional location. Just 3 blocks away from the newly revitalized East River Greenway, it offers easy access to recreational spaces and a popular route for drivers, bikers, and pedestrians. The property's proximity to major transportation hubs, including the FDR Drive, the Brooklyn Bridge, Manhattan Bridge, and multiple subway stations, enhances its connectivity to the various parts of the city. So again, having invested in London since 2002, what is absolutely critical is you're close to tube stations, you're close to transport, because that is what fuels not only your rental demand, but also your property price growth. And it's literally, as I said, in the heart of the financial district. So it's without further ado and a lot of excitement that I wanted to welcome Selwyn for coming to join us. And Selwyn, thanks so much for joining us live. I really, really appreciate it. You know, you're part of the Callio Private Equity team, and yourself and Glenn are both the co-CEOs of the Callio Private Equity team. And I just want to read quickly your bio here. Selwyn has over 20 years of experience in consulting and banking, locally and abroad. He began his career at McKinsey & Co. in Johannesburg, undertaking projects across Africa. He subsequently co-founded and managed RMB's opportunities in the global real estate portfolio, and later co-founded RMB's Westport Real Estate Development Fund, the largest sub-Saharan African real estate private equity fund at the time. Prior to joining Callio Private Equity, Selwyn led ABSA's commercial property finance business in Africa as a principal at the ABSA Group. He currently serves on the board of trustees at the African Leadership Academy, and also has a PhD in mathematics from Cambridge and a BA in honors in mathematics and economics from Wits. So, Selwyn, without further ado, it's wonderful to have you here. I really, really appreciate you coming and sharing with us. And I know that you work with Glenn. You guys work in a partnership, and often Glenn is out on the front line meeting with different investors, and you're analyzing the deals, doing the due diligence, etc. Do me a favor and just explain to people a little bit about Callio Private Equity and how you and Glenn and the rest of the team operate in terms of, I know collaboration is something that's so important to you, but just talk to us about the methodology of Callio Private Equity before we get into the deal.
Well, Scott, as you know, we're not a conventional private equity house. We don't manage a fund. We don't manage a pot of money that is deployed at our discretion. We find individual transactions and then match investors to those transactions. And so that gives us, I think, a closer link to both the investors and to the investees. And then we create individual vehicles for those investments. Our mandate is open as well as a result of that, because we aren't beholden to a particular initial starting mandate, as many private equity funds are. We aren't bound by exit constraints and strange fee structures, which you find quite often in private equity funds. Then we're a small team. It's Glenn, myself, in terms of active full-time deal makers, Glenn, myself, and Sigle Godden. Three of us work together on the deal side. We have administrative backup, both dedicated to ourselves, and we also use Callio Capital's infrastructure, and we rely quite heavily on their intelligence and network. One of the key distinguishing features, I think, for us is our use of the community that we operate in. And we call it a community, and that's quite that's a careful choice of words. It's not just a network of people. We've got investors, people that have invested with us previously, who refer deals to us. We have existing investees who refer deals to us, and we build up relationships over time. And we're able that way to do, I think, a far more meaningful due diligence than you'd be able to do if you hired external research, or if you paid somebody to do web research or to do interviews or something like that. So every deal that we get is normally sourced through some kind of trusted pipeline that we have. So the deal that you've been talking about now, the Manhattan property deal, that came to me through one of the principals, one of the sponsors, who I've known for over 20 years. So it can be personal networks as well. So I think
let's go to that. I mean, let's go to that, because I think one of the things that I've loved, in the different webinars and masterclasses and interviews that you and I and Glenn have done, is really for people to understand that I always say, when it comes to investing, there's two simple things you need. You need the right information and you need the right partners. And they're symbiotic, because, generally, if you've got the right partners, they should give you the right information. But a lot of people go out and they invest and they make mistakes because they think they're getting the information. It's the wrong information, and they have the wrong partners. So where you're going back, and particularly when we talk about safety and risk, one of the best ways that you can manage risk is by the quality of the partner that you're dealing with. And so as you just now shared your website there, showing the collaboration, etc. Talk to us a little bit about, these partnerships and how you guys operate, because it's very much a network-based approach versus a spray and pray approach. And then if you wouldn't mind, I've got, the partner with regards to this specific deal, and let's just use this as an example of how you use partnership to do due diligence.
Yeah, so quite a big question. So I think we've just over the years, just by being in the investment markets and through our links with Callio, we've built up sufficient relationships to understand how people work, how the people that are in our community work, how they assess opportunities, how they assess other people. And when an opportunity arises, we're often called in to assess it and to take it forward. So again, I think the key thing is having the right kind of sources. Somebody who says, I went to school with this guy, I've known him for ages, I was in business with him in some other setting, he did really well, he managed through difficult situations, I've seen him under pressure, I've seen him work in different markets and so on. So that helps us a great deal. I have the advantage of having worked in consulting, worked at IE, worked at ABSA, and have had interactions with a lot of colleagues and clients, and that has helped me a great deal. Glenn has his own network. From Callio Capital has his own network, and putting these things together, I think we're able to source deals in a very powerful way. This particular transaction, you put up the name of Travis Stabler. Travis has worked with a friend of mine for many years. They've done multiple projects together. In New York specifically, Travis is a proven safe pair of hands for this kind of project in particular. So he's somebody who knows how to take an existing building, to manage it through the planning process in New York, which is not straightforward, and benefit from things like historical tax credits and other features of the market that are pretty unique to that location. And one thing about property is there's a lot that can often be highly specific to the jurisdiction that you're working in, and that jurisdiction can be just one municipality, for example. So Travis has worked closely and has been an investee and co-investor with a very close friend of mine. That friend of mine, Duncan Randall, is also one of the sponsors team for this particular transaction, and he brought the deal to me. And I think this is a kind of case study where got a trusted partner or trusted source for the deal, and he himself has been involved and is taking risk. He's an investor in this transaction. He's putting a substantial amount of his own money into this deal. And he's eager that people that he knows and trusts invest alongside him. So that's also an important part of how we operate, is that we want to be a trusted partner to our investees and to the other people who introduce us to transactions. Yeah. So that's I think also part of the ethos that, Scott, that you promote.
Yeah, well, look, I always say there's three things primarily that we look for, and you've already actually touched on all three of them. Firstly, you're dealing with someone with at least 10 years plus track record. In this case, the team's got over 100 years of experience collectively in terms of the space. Secondly, you're dealing with people in a niche. So as you said, to just go and do a renovation in America, in New York, even worse, it's very, very, there's a huge amount of red tape in New York. And, and so to jump through all those hoops, know how to do it, and more importantly, having done it before, you can actually see here that they've got 4 projects currently under development in New York, 2 of which are historical rehabilitation. So again, back to a niche that, this is what they specialize in. If I try and go and do it, or in my opinion, if any investor tries to do it, even if they got $100 million, they're going to get cleaned up because it's not their area of expertise. And the third thing, and probably the one that's most important for me, is, are we all on the same ship together? Have they put their own money in? Are they being treated the same way? And as you say, it's a substantial amount of capital that they're putting in of their own capital. So, they're tied to the same ship. And that's really important from an alignment perspective long term. I think also you can see here in terms of the experience and what they've got in terms of, and this is just one of the members. And as, someone mentioned, there's actually many different partners. And when you read the investment documentation, you can go and read through all the different partners and how they operate. But I think in simple terms, what we can say is we've got a partner, they've got a lot of experience, they've got a lot of experience in this niche, they've got money in the deal. And, you know, one of the things that I find really interesting, and I'd love you just to talk to a little bit, this deal, they need $10 million. I know you guys originally wanted to put a peg in the ground for $2.5 million. They've gone out to their network, and as I understand it, it's oversubscribed. From Americans in America wanting to invest in an American deal, which is a hell of a lot better than a bunch of palookas from overseas, you know, taking down an asset that no Americans want. It's very different.
Yes.
Americans want this deal. Talk to us a little bit about that.
Yeah, so there are different categories of funding, but yes, there are many people who are very close to the asset itself, or who'd be able to vet it very easily, who are invested in providing capital to it. So in terms of our own journey in this, yeah, we've been cut back in terms of the allocation that we've been able to get, just because of the level of interest. And that level of interest is a function of two things, Scott. One is the deal itself, because it is very compelling. I mean, I joined this webinar at the back end of your discussion. The basic premise deal is very, very compelling. It's a good sector, right operators. It's the value proposition is very carefully constructed. That you're a senior lender with a lot of coverage from the asset itself, and with good prospects of being taken out and being serviced. Very strong prospects of all of that. So there's the compelling offering, and then there is the team itself. We're not the only people in the network of this team. This team, because of its successful track record, is very popular with the investors that have come into previous deals. Yeah. And so it has the Rivington team has a following from an investor community, not just in America, but abroad. So it's got a very broad, very wide range of sources of capital. They've been happy to work with us, partly because of a long association with me personally, but also because I think they see that there will be more deals and there are more opportunities as the market evolves. But yeah, those are the two elements, both the attractiveness of the individual transaction and the fact that you've got a team that has been able to build its own network and following and investor following.
Well, you know, it's a good way to pivot. So, you know, for me, we can, in many ways, tick the partner as well. And so now we go down to the property. And what's interesting is that here the picture is, you know, of the church that's being renovated. And what I think is awesome is, you know, pictures always speak 1,000 words. But just to give you a bit of an understanding of what it's all about, this investment opportunity is acquisition and transformation of a historically significant property, 53 Catherine Street and 5 Monroe Street in the Two Bridges section on the Lower East Side in Manhattan. The property holds immense potential for redevelopment, and its unique features make it a compelling investment prospect. The property under consideration is a landmarked Catholic church, school, and rectory. Its historical significance is not only a testament to the architectural heritage of the city, but also presents an opportunity to revitalize a piece of New York's history. The landmark status provides a unique blend of charm and character that can be leveraged in the redevelopment. I'm going to talk a little bit about that just now. The mixed use potential. So the property also has the ability for mixed use between residential and commercial, and it's got 50,000 square feet, which is about 5,000 square meters in terms of space for innovative design and utilization. This is the one that I wanted to mention, the architectural charm. The high ceilings on each floor, as well as abundant natural light and air, creates a welcoming atmosphere throughout the property. Street-facing windows on two sides and rear yards along the northwest section enhance the ambience and functionality of the space. So, and I'm sure you've been to New York and can attest what I'm about to say. When you go to most properties in New York, like you can swing like this, and that's the size of the property. Your ceilings about here, you know, it's all on top of yourself. And so for me, what's unique here is that any normal multifamily that's being built is going to be a new build. They're all going to be exactly the same. They're going to be square boxes. Whereas here you're dealing with, and you can see it in the pictures, I'll share them just now, where you've got nice tall ceilings and big windows. Just imagine a big old church that's being converted into the unit. So I really think this is, again, a unique feature because you can't just recreate it down the road. It's as I say, it's an architectural charm. I don't know if there's anything, and please just jump in if there's anything that I'm missing in terms of importance.
Yeah, so Scott, I mean, Scott, Scott, what you're saying is exactly right. But not every team and not every developer is able to retain the historical charm as they redevelop. And one of the things that this team has done is work on a design that maintains the historical integrity of the building. So it has this appeal. And New York actually offers historical tax credits to developers who do this. So that actually helps the economics and the value of the asset. So once you've done that and acquired historical tax credits, those are actually an asset that support the debt and support the equity in this transaction.
Well,
So that's actually something
like
just
$10 million is that tax credit, is it not?
Yes,
I mean, substantial
it
amount.
it can be. Yeah, they're actually expecting up to $10 million in tax credits as a result of doing that for this building.
No, it's amazing.
So
let's just talk about the location a little bit more in terms of the Two Bridges neighborhood. So again, this is all in the brochure, so I'm not going to go through it in terms of, reading it all out specifically, but it's basically nestled between the Brooklyn and the Manhattan bridges. The neighborhood has witnessed a substantial development in recent years, evolving from a working class and immigrant community into a vibrant mixed-use area. The market potential is poised for continued growth and increased property values, with large-scale development projects in progress, including the construction of a new pedestrian bridge and the development of a waterfront park. It proposes a dynamic and appealing environment for real estate investors. And then something else that I found really interesting is you always want to try and buy property, below market value. And this property has been bought at $14.5 million, which is $255 per square foot. And yet, if you look at the rest of downtown Manhattan, it's ranged between $500 and $1,100 per square foot. So you're buying it at a significant discount. And then also, here are those tax credits that Selwyn was talking about, which, the subsidy could be upwards of $10 million. So very, very attractive numbers that are being put forward. And again, back to the fundamentals of the investment. Then just to give you a feel, and this is exactly what Selwyn was talking about. So this is obviously rendered pictures of what it will look like once it's complete. But this is the feel for what it'll look like once it's complete in terms of the renderings. And, again, this would be someone's property in terms of the process. So very, very different from the typical new build that you're going to live in. And you can see here very high ceilings in terms of this whole process. And again, very, very unique and characteristic. And then just to manage this, these are the current pictures, of what it looks like at the moment in terms of the, before the renovation, etc. Some, just to give people a perspective. So let's get down to the numbers and the investment summary. So the project is zoned as of right residential use, so it doesn't need rezoning. However, it still needs to go through the development, the Department of Building, and the idea is that it'll be shovel ready, which basically means that they can start building within 12 months. And this, as I understand it, Selwyn, is the reason for them needing the debt, because they want to basically procure the property. They need to get the property all ready. It's going to take about 12 months to be able to start development. And this is my understanding in the capital stack of why the debt is required. Am I correct in that understanding?
You're correct. So once all of those things are in place, it becomes much easier to refinance using construction debt, conventional construction debt. Yeah. But in general, construction financiers do not like going through the process of approvals and regulatory processes.
And again, New York
and they price.
New York's like London. If you're wanting to do rezoning and stuff, I mean, it can take 4, 5, 10 years. So the fact that it doesn't need zoning or anything is really, really material in terms of that process. Then in terms of the investment that you and I have the opportunity to partake in, it's a 12-month loan and it's providing a clear timeline. It does have a 6-month extension option. So that allows investors the opportunity to extend the investment by 6 months should the market conditions or the project development necessitate additional time. And what you're dealing with is an interest rate. So it's a debt with an interest rate, and it's 1% per month with payments made quarterly in arrears. This ensures a steady stream of returns to investors throughout the investment term. It's secured by a first mortgage. So what that means from a risk perspective is the loan is secured by a first mortgage. So over the property, it's a leasehold property, providing a robust level of security for investors. This first mortgage position further strengthens the investment's collateral. So again, I said right in the very first slide, imagine being able to invest in Manhattan, imagine being able to earn an income north of 10%, and imagine having your capital protected by a first mortgage position. By the way, that's exactly how banks invest. They take a first mortgage position So you're the same as when a bank invests. And then also the loan to value, very similar to a bank. The loan to value is starting at 60% over the course of 12 months and actually reduces to 35%. So again, most banks they're not comfortable lending over 60, 65%. So again, it's very much within the parameters of conservative borrowing against an asset. Would you agree with me, Selwyn, on that? That, really as an investor here, we're acting like a traditional bank on the same parameters that a traditional bank would do it. The only reason they're not using bank debt is they want to move fast, and the traditional banks take far too long.
That's exactly right. But the refinance is likely to be from a conventional construction bank once we reach the end of this process.
Awesome. So just to finish off, basically, and people ask me sort of how would it work. So for us, you've got the investors. Each of us have our bank accounts. We go into our investor wallet. We go on the digital marketplace, Migrate. We basically go into the investment opportunity, the Manhattan deal. We aggregate everyone's investments, because to invest individually, you need at least $100,000 plus. You go through a tax efficient SPV, and ultimately you own the investment. Then when the returns are paid, it goes back into the deal wallet, and then it gets distributed proportionally into everyone's wallet. So it's very simple in terms of the process flow and how we use technology to make it easy for investors. And I think to sum it up in three separate little bullet points, you're looking at a total cash on cash return of 12%. But if you take off some of the fees in terms of the SPV and setting it up, we're looking at a target return north of 10%. Actually, if you go on the platform, it's sitting somewhere at about 10.5%. You've got an investment term of 12 to 18 months, and you've got a first mortgage security. And I must admit, Selwyn, for me, it's a funny one. For years, people have said to me, Scott, how do I invest in America and get more than 10% cash return? How do I get a short-term deal? Like, I don't like your big long-term 5-year deals. I want a short, 12 to 18 months. Oh, and by the way, I'd like to protect my capital.
Yeah.
And like I've always gone, guys, that's too good to be true. That doesn't exist. And now basically you guys from Calio have gone, well, here it is. So, I always get scared when I do these things, because next week people are going to say to me, or next year, they're going to, well, I want the same as that Manhattan deal. And I'm like, I haven't seen it in 10 years. And my gut feel is I might not see it for another 10 years. I don't know what your feeling is. I mean, you've been doing this even longer than I have. This is not normal.
No, it's not. It's partly a function of the anomalies currently in the lending market in New York City and in the United States generally, where banks are targeting their lending capital, where interest rates are, for example, and then the particular way in which the sponsors wanted to approach this. They felt that there wasn't a particular benefit. It was very difficult to work with the banks. It was easier and more cost-effective, all in all, to approach things the way that they've approached it, and to make this offer to the market. When I say the market, it's the people who are in their immediate networks. So that's how this has arisen. It's not normal. I cannot find you, and if I had another one to offer you, Scott, to offer you and everyone on this webinar, I would, but I don't. Not yet. So hopefully soon, but not yet. And then if we do have something which is similar, it'll probably come through a similar channel, or literally from the same team. I'm hoping actually from the same team. At least that's easy for us to understand the way that they work and why they approach it this way.
Completely. And I think for me, Menno actually asked the question here, is Selwyn part of the Calio or the Rivington team? So the way that, just from an understanding perspective, Rivington is the sponsor on the ground. They're the ones that are actually executing on the deal. Calio Private Equity are effectively the due diligence partner. They're not only bringing their own private clients to invest, but they're our partner in this deal in terms of the process. And Selwyn and Glenn are the two co-CEOs of Calio Private Equity. So again, just to make it easy for you, Menno, but if you go to the team here for Calio Private Equity, you can see you've got Glenn there and you've got Selwyn. So just hopefully that makes it easy for you in terms of the breakdown. And then what I wanted to share with you was just a couple of things. I actually went through this. We always like to do this just to make it easy for people. But in terms of the risks, so I think the one risk is that the investors are not able to, the interest is not able to be paid by the developer. Selwyn and I had a quick chat today just to understand this from a risk perspective. And again, it's built into the financial modeling in terms of the deal at large. And if you actually look through the risks as I see them, you've got the market changing risk, but again, your capital is protected by a first mortgage over the property, just like a bank. So that's why the loan to value is really important. You've got a development risk. So normally, if you're partnering with a developer and you're taking an equity position, there's a lot of risk in whether they actually do the development right, etc. In this case, you're not. You're taking debt, and so you're not exposed to that development risk. You've got project and development approval risk. So this is something where they've already got the zonings already in place. Yes, they've got to get the development approval, and their target is within the 12 months. But obviously, everyone's been part of, planning and stuff, and sometimes there can be delays. But again, you've got a highly sophisticated team that's done this a lot. So, these risks have been analyzed. I fundamentally believe there's not an investment on this planet that doesn't have risks. But what I do like to believe is showing people what they could be. Planning and program risks. So again, in any project management, there's the execution in terms of it, the financing and funding. So again, someone's already mentioned that once the planning's in place, then you'll go and get the construction finance, etc. And obviously that needs to take place. The cost and budgeting risks. So again, they've done their financial modeling to be able to pay the interest, etc. And the assumption is that that's all done right in terms of that process. And then finally, the foreign currency and exchange rate risk. Obviously, if you're going into US dollars from pounds or something, there could be a change in currency. So just from your perspective, I mean, this is your area of expertise in terms of the due diligence and everything else. Just talk to us just a little bit about, from a Calio perspective, yes, it's a partner, like and trust, you've got experience, but you've also spent time looking at the models, making sure that, they've got substance, etc., to make sure that the numbers work.
Yes. So in this case, it's actually relatively simple because there's an underlying asset and there is a basic budgeting exercise that's gone into raising the capital. So unlike various other property risks where you'd have to make assumptions about tenancies, OPEX, and so on, for this particular instrument, things are relatively straightforward. So obviously, I needed to get myself comfortable on the end product as well. Is it something that's going to be financeable by a bank? Is it going to be something which makes sense for equity financiers to put money into as well? So that all of those things provide comfort to anybody who's taking up the position that's being offered now. So I feel very comfortable with the way things have been set out and the way in which it's been modeled and the way in which the assumptions have been made underlying that modeling. As you've said, Scott, one of the biggest supports is really the market study. That's the way I see it. That big difference between what we're paying per square foot or what the sponsors have negotiated per square foot and what the market is at gives you a great deal of comfort in terms of the value. Yep. Your protection as a senior lender is in the value of that asset. You have additional comfort that the development team will take this project to a point where it'll be ready for refinancing by a commercial bank or by equity financiers or whatever is most likely a commercial bank that will provide that will provide conventional construction financing for a conventional construction project. So yes, we've gone through that. We've gone through the basic thesis for this. Currently, it's a project for the project, and I think that there's a great deal of support. The key thing, and I think I have to give credit to Warren Buffett for this, and I'm sure Warren Buffett gets quoted a lot in your webinar, Scott. But I think that for me in this kind of thing, the issue is margin for error. If there's a slight delay in the project, what does that do? If the planning permission only allows for a few fewer apartments or apartments of slightly different dimensions or something, what would happen? Firstly, how likely is that? But also, what would happen? And I think in this case, because of the way things are structured, there's actually a great margin for error. And so I think that's whenever I go through these models, I know reality is never going to be exactly as the model shows it to be. Yeah. But there has to be that margin for error. There has to be some kind of reality to the assumptions, which allows you to believe that as reality plays out, things will be headed in the correct direction.
No, that's brilliant. And I think the final one here was just the sponsor continuity and sort of company operational risks. And again, we've spent quite a bit of time talking about the partner, the track record, the substance. In fact, I recommend you go and read up the material on the investment, because there's actually another partner behind them that's a huge construction and development company as well. So there's a lot of substance.
Yes.
What I wanted to do here was just to sum it up in terms of the things that I have pretty much been through today. So firstly, buying the property at, literally 30% below the market value. I told you, you're buying it at 225 and it's anywhere from 500 to 1,100 per square foot. The zoning is already in place. You've got an established partner with a long track record. You've got a niche focus, so residential conversions in New York. You've got, they're putting their own money into the deal. Selwyn said, actually substantial capital. You've got strong fundamentals in New York, especially Manhattan. You've got location, location, location. We've all heard this 1,000 times, but you literally are right next to the New York, Stock Exchange, the World Trade Center. You've got 3 different bridges. You've got all the subways. I mean, I've taken you through it all tonight. You've got a unique building, a trophy asset, architectural charm. You can't just replace it down the road. It's a very unique opportunity on its own. You've got an income producing asset that's going to be earning at least 10% plus income per year. Then you've got your capital protected by a first mortgage with a nice low loan to value. So just like a bank, you're in a very solid position there. You've got a 12 to 18 month time frame. So people are like, well, I don't want to invest for 5 years. You don't have to. It's a 12 to 18 month time frame. And then finally, as Selwyn very kindly has come to join us tonight, it's the Calio network, the DD that they've done, not only because they know the partners, but as he's just spoken on the substance and the modeling. And I think probably something that gives me a lot of comfort, which by the way, a lot of gray hair as well, is that there's a huge amount of demand for this deal and everyone's scrambling to get in, in terms of this process. And so that for me is it in a nutshell in terms of the overall opportunity. In summary, it's an investment opportunity that encompasses a well-structured financial arrangement, offering investors a clear and secure path with a flexible investment term, 12 to 18 months, a robust interest rate, 12% per annum paid quarterly, and an option for senior debt lenders to become equity stakeholders at the project's conclusion. This comprehensive financial strategy is designed to maximize returns while maintaining a prudent level of risk management and situated right in the heart of Manhattan. And so for me, Selwyn, I pretty much am done, sharing everything. I want to just launch a little poll for people. If they are interested, go to the poll and let us know if you're keen. And what I'd love to do, Selwyn, from your perspective, is just any closing comments or thoughts with regards to Manhattan. You've been wonderful tonight. You've shared a lot of valuable information. Any closing thoughts for the investors?
Well, Scott, I think you've covered it. I think you've covered it. I would like to say, you say that you've been given grey hairs by various things. I can unsee those grey hairs. so just I want to point that out. But I think you've already I think you've mentioned it in one way or another many times, which is that this is actually quite a rare opportunity. So Calio Private Equity, we're gonna try and find more of these kinds of opportunities to present to you and to people on this webinar. But yes, as things currently stand, this is a rare opportunity. And I think it also is a good complement to many things that your audience is likely to have existing in their portfolio, things like equity, things that involve equity and property equity risk, for example. So that's something else just to consider always is how it fits into a portfolio. But this is something which I think is very neat as a portfolio addition, because it's income generating, relatively short term, and is fundamentally different from conventional equity risk.
Brilliant. And what I wanted to share with people just very quickly, and I'm super excited to share this with you. So the deal is live on the platform, under preview on the platform. We're just waiting for one last step. But if you go here now, you can literally go in, you can see all the different returns. You can actually see a video. You can see the pictures of the deal. You can go look at the risk. You can read all about it. You can do the calculator, so you can work out all the returns. You've got the documents, the brochures and everything here, the risks, the milestones, the investment summary, the market summary, the distributions, the due diligence, and the deal structuring. And hopefully tomorrow, that will be open in terms of people being able to invest. I have seen a bunch of people asking me questions. We are going to start with a minimum investment of $10,000 because we have to move really quickly here from Selwyn and the team's perspective. And if there's capacity in a couple of days, we've got an investor roadmap, we might drop it down. But certainly for now, we're starting with the $10,000. We'll let you know if we get some capacity in terms of that process. So I'm going to end the poll. If anyone else wants to fill in the poll quickly, just go for it. In terms of the process, those that want more information, etc., literally, go and download the brochure. They're all here. There's extensive detail. Everything that I've shared tonight is already here, both our brochure and so if you look here, you've got the entire brochure. Everything that I shared in the PowerPoint is actually here, plus more detail. And equally, if you want to go, you can actually see the this one, which is let's let it download quickly. And this is the full sort of breakdown. So you've got everything. So it's all in one place for you to get that information for people that want more information. So and the last thing that I wanted to do just before we duck was I'm super excited that with you and Glenn and your team, we've actually got 2 more deals that are coming. And I don't want to take away from the Manhattan deal. But what I get super excited about is, I'm passionate about diversification. And, tonight, or certainly not tonight, but in the next 7 days, I can invest in Manhattan, I can invest in Germany, I can invest in Augston, I can invest with 3 different partners, 2 different countries, 2 different currencies, 3 different types of assets. And just tell us quickly the sort of the 2-minute overview of this German deal. Again, the partner, the deal, slightly, it's a different deal. It's an equity deal. And just by the way, I'm going to be going into this in a lot of detail on the investor roadmap on Saturday. I'm conscious of people's time tonight, but while I had Solon, I thought I would take a chance and just ask him what his thoughts were on this German deal. Are you there?
Yeah, so this is just just by Encore Properties. Encore Properties, point of view. Personally, I've been involved in I think it's 3 or 4 others. I have to actually go and count how many other deals that I've been involved in with them. And they're led by somebody called Peter Katz. Peter was the head of Redefine previously. And this is a more conventional property investment in the sense that the investors will come in an equity. But I think, Scott, your point on diversification is well made. This is a mixed-use development that includes a hotel component, a basic needs, a retail component, parking, and so on. It is a strategic asset in the town of Wuppertal, which is a town of about 350,000 people in the greater Düsseldorf area. It's about, by train, half an hour between the centers of Düsseldorf and Wuppertal.
What
so that gives you some sense. It is a core asset. It's not heavily levered. Sorry, Scott. I think I'm having issues with my internet. Apologies.
That's all good. No, you finish. I'll go when you're done.
No, I think that's it. I think what you see are very good returns. The cash on cash of roughly 6. We'll see how it turns out in the coming days in terms of the modeling. But we do expect a very good IRR. The entry price that's been negotiated is at quite a good discount to current market. And it's got very strong in-place leases, including with some of the biggest operators. So, for example, Net, which is part of Germany's biggest supermarket chain, Postbank, which is part of the Deutsche Bank group. Those are amongst the major tenants. There's a fitness center which is part of the RSG group, which is actually the biggest such group in Europe. So it's very solid tenant base. There is a little bit of value add in terms of managing the existencies, but you actually come in at a very good level. So this is a good, I would say, core, but perhaps edging towards value add asset.
And just interesting, Solon, you sort of touched on it. You've done 3 deals with these guys already. You've had good exits with them. I know that I tried to get into a deal with you guys in the middle of COVID, actually, and it was 700,000 euros. And I ran around as quickly as I could to get all the investors. And we tried to put it on the Wealth Migrate platform, and we just couldn't execute it in time. And it was so bloody irritating because 18 months later, you exited that at a 1.8 multiple, which basically means if you put $100 in, you got $180 out in 18 months, which is a internal rate of return of like 40%, which is, it's unbelievable. So, I've been trying to get into Germany with the Calio team for 3 years now. And so just like Manhattan, it's a different type of opportunity, but I'm equally as excited to have an income producing asset in Germany. Again, Germany, the heart of Europe in terms of a powerhouse. But again, we'll go through that more on Saturday at the Investor Roadmap, where I'll talk, about the details of this deal in terms of that process. But it is an equity deal, 5 years. And as Selwyn said, a mixture between income and obviously capital growth. And then finally, the last one for now is, and there's, as Selwyn's already alluded to, there's some more exciting ones coming down the pipe. But for now, it's a private equity opportunity out of Austin, Texas. It's a company called Backed. And again, Selwyn, just tell us a little bit about this one. This one's different. I know you guys have personally put in, between you and your investors, north of $20 million between equity and debt. So you've significantly got your money where your mouth is. But why is this attractive for investors?
Yes. So this is a different kind of risk. This what's being offered, Scott, is mezzanine is mezzanine lending to an existing lender. Backed is the operating name of a company called Austin Business Finance. That's why you see both names up on the slide. And what Backed does is offer working capital loans to businesses. So what by American standards are medium-sized corporations or small businesses, but by South African standards would actually be quite substantial businesses with millions, sometimes tens of millions in annual revenue, tens of millions of dollars in annual revenue. And what we're offering is lean product, which will allow you to fund the company. The money goes into the book, goes into the loan book. And because of the high interest rates that are achievable in this lending segment, we're able to offer the kinds of rates that are put out there. So it's 10%, 9%, I suppose, after fees and other costs. But it again, a different kind of instrument with a set timeline and repayment schedule. So that's just something for people to consider. Again, this is a good income earner with kind of regular payments being made.
Yeah, and I know that you've helped a number of our mastermind participants actually invest in this, and they've been very happy with that regular income that you're talking about in terms of that process. Yeah, so what I want to do,
very true.
After you.
Yes, Scott, it is very attractive as an income generating asset. Been very consistent. We've been involved with this business since 2019, just before COVID. It survived COVID, in fact, grew through COVID, which was very impressive. So it clearly has strong credit instruments. It has strong backing and strong management in place. But it is a mezzanine instrument, and the risk is mezzanine. But with the regular income, I think that makes it very compelling as well.
Perfect. Okay. Sorry, so I just want to there's a couple of questions that come up. So what I want to do is just launch this, the next poll. So again, just if people are interested in the German deal and or the Austin Finance deal. And just while that's up, I just want to answer some questions here. So Andile said, what is the minimum investment value in the deal already on the platform? So Andile, as I said, we're starting with $10,000, and primarily because we've got a real race against time with regards to the Manhattan deal. Will the minimum investment be 10,000 as currently listed? So yes, it will to start off with. And if there's capacity by Saturday, we'll try and drop it if we can, but we can't guarantee that. There's already a lot of demand, particularly from our top investors and mastermind participants. Any chance of purchasing one of the apartments? I don't actually know the answer to this question, Selwyn. Any chance of purchasing one of the apartments after completion at a special rate?
I'm not sure I can commit on apartment sales. So yeah, just hold on that one.
There's a
I
chance
like
that
the question. Thank you for the question.
there's a chance to take debt and then ultimately possibly roll it into equity, you know. But I think that we should have a one-to-one
Yes,
about that rather.
yes. But again, that may not get you an apartment. The apartments may still be out of reach for many investors.
No. Well, from my experience of New York property and just looking at those properties, I don't think they're going to be trading much less than $1 million plus, you know. Okay, Ilda asked, I have details for Lemonway from about a year ago when I last invested. Have their banking details changed? Possibly, Ilda. So please just make sure you get, you double check that, because I know that did change somewhere in the last year or so. So I just want to make sure you got the right one. Menno said, I think the investors will be wanting to start spreading their investments over various deals, as I know I would. Sitting with 100,000 to start initially in a small portfolio, but not all in one deal, have recently started doing this via easy equities. I would like to diversify in a similar way on Wealth Migrate. So, Menno, that's exactly what we normally do. And, as you know, our minimum investment has been as low as $10. So again, if, ideally, if you've got $1,000 and you want to put it into 3 or 4 deals, that's where we want to go. Just with the Manhattan deal, Selwyn and Glenn have been beating us with a stick. And we've really got a timing issue here. With some of the other deals that have longer lead times, we will certainly, that diversification is what we are deeply passionate about in terms of everyone, understanding it. Derek is asking Selwyn, the mezzanine, in terms of mezzanine debt. I'm happy to actually show a picture of what I've actually got let me just.
Yes, if you could, Scott. So, I think that's actually the easiest way to show it is how it appears in. I'm just hoping people on the webinar can see.
So just quickly, this is what's known as a typical capital stack in a building. Okay. And normally you've got the bank debt, which is generally about 60%, that your loan to value that you get from the bank. Then often there's like a private equity component that comes in, and then finally there's an equity component that comes in. Please, Selwyn, please shout if there's anything you disagree with in this process. And I'm not actually sure where you were talking about the mezzanine, but I think what you were referring to is that normally, if we were going to buy this Manhattan building, it's a $14.5 million purchase price. And we would go out and we'd go speak to a bank and we would get 60% of the finance from a bank. And the rest we would borrow in private capital, whether it's equity or private equity. The point being is that here, and not going to a bank, they're getting, I think this is where he refers to the mezzanine. They're getting private debt of the 60%, where they're giving an attractive rate because the capital markets in America, the banking markets in America are so difficult at the moment. It's actually easier to go out and to get private debt to offer pretty much the same security as a bank takes. Yes, it is slightly more expensive, but there's time value of money. Again, I don't know if that sort of sums it up from your side, Selwyn, or if there's anything you would add to that.
Scott, I think Derek and the others on the webinar may have heard me use the word mezzanine in connection with the Austin Business Finance backed lending.
Okay.
So just to explain what it means there, the principles that you set out in terms of a property structure are still apply in a normal operating business. So Austin Business Finance has senior debt actually from Fortress, one of the world's biggest lenders. It has equity, which includes equity that we've contributed, as in Calio Private Equity has contributed, and various other equity providers, including the management. But then it has these loan instruments which fit somewhere between those two. So it's a genuine loan instrument, but it isn't the top, as in it isn't the most secured or first ranking loan. So that's what I mean by mezzanine in that context. That it's so-called subordinated, so it's below Fortress's loans, for example.
Cynthia is online. She's part of the mastermind, and she just said the New Yorker here wants first dibs on the Catherine Street apartment. So that's a good sign because she's from New York, and so
I think what we must do is invite the developers to start their pre-sale process
exactly
on this webinar.
And then Menno said, I reckon, let me just end the poll here. I reckon you will be getting a large number of small investors rather than a smaller number of large investors. Yeah, look, I think, Benno, I agree with you. And, you know, what I'm super excited and what I love about the Wealth Migrate platform is that, you know, for someone like Selwyn, you know, they only deal with people with $100,000 plus because it's difficult and you're dealing with one human at a time. And obviously it's manual, but with it being digitally, you know, it's frictionless in terms of that process. So, but it is a dance. There's still an education to it, and I'm sure Selwyn would agree with me. The really prime sponsors and the really prime properties still don't really want to be associated with retail, so it's always a challenge as well in terms of that bigger picture. But that's I think that is changing over time as people are starting to realize the power. 1 million people with $1,000 are more valuable actually than, you know, a couple of hundred people with you know, lots of money. So. Okay, so Derek has said thanks, and Menno said exactly, yep. So now we're all on the same page. So I think in conclusion, just to finish off for you all here, and I know Selwyn, it's late for you, so I literally will finish off now quickly. What has happened to my screen? 2 seconds. It's not letting me. What is it doing now? It's not letting me share. Oh, there we are. I can share again. So just to remind you all that on Saturday, I will be running with the team an investor workshop. Again, this is something where we literally take you through how does it all work? What are the investment categories? How does due diligence work? How do you manage risk and compliance? How do you set up your investment platform? How does the platform work? How do you actually invest and how do you earn money? I tend to call it the why, the how, and the what. We've done many, many of these. We've had a huge amount of success with them in the past. So if you want to go to the link, investorroadmapworkshop.com, you've already tonight gone into detail around Manhattan, and probably by the weekend it'll be gone anyway. But on Saturday, I'm going to be going into the German deal. I'm going to be going into the private equity deal in a lot more detail. And then we've got another investor roadmap coming up on the 24th of November, which will be the final one for the year in terms of that process. So in conclusion, I remind you all, and you've seen this many, many times, a bird can fly 70% further on its, you know, in a flock than it can on its own. I don't believe that if I had $10 million, I would be able to get into this deal because I don't have the partners or the networks or the due diligence, etc. But by us coming together through a partnership with Calio, we now get access to those quality partners, quality opportunities, and quality information in terms of where we're at. As Nelson Mandela said, money won't create success. The freedom to make it will. And there's a lovely little video here.
I have walked a long walk to freedom. It has been a lonely road, and it is not over yet.
Selwyn, I just wanted to say thank you so much for joining us tonight. It's always a privilege and a pleasure in terms of understanding, you know, literally from the horse's mouth, what is happening on the ground. You know, you and Glenn, you know, really have a huge amount of experience in this space. And I think there's so much that you've got that you can share with people. So I just wanted to say thank you to you for joining us. And, you know, really, I don't know if you've got any closing thoughts of anything that you want to share with people. I'm going to launch the final poll. But yeah, I just wanted to say thank you. And is there anything else you want to share with people before we close out?
No, Scott, I think you covered it in terms of the individual investments. Always a pleasure to work with you, to listen to you speak to investors and to convey some really important ideas. You know, value, diversification, collaboration, and so on. So thank you.
Awesome. Well, thanks so much, Selwyn, and we're super excited about this partnership. So thanks for being online, and to all the investors who've turned up tonight. I hope you are equally as excited as I am. It's really hard. The reason I started, and Selwyn, you didn't see me right in the beginning. The reason I started with showing those American houses 10 years ago was we came back and I was like a kid in the candy store. I was like, guys, you don't believe how good it is. You can buy houses for $60,000, $70,000, $80,000, and their replacement cost is like $140,000, and the rand is at R8.50. Like, this is a no-brainer. Like, and people are like, sort of look at you like you're a bit mad. And then 10 years later, they go, wow, like I wish I had taken advantage. And the reason I started with that story was that's how I feel about, you know, Manhattan and Germany, to be honest, because it's like I haven't seen it in 10 years, and I've been doing this for 24 years, you know, and I just really hope that people, you know, can understand that this is unique. And like you said, it's because the capital markets are, you could argue, are in trouble, but equally chaos equals opportunity, and that provides us as investors with opportunity. So don't think it's going to be like this forever. It's just not like this. You know, in 2009, we bought those incredible deals with massive discounts off developers. You know, and nowadays, we all wish we could have done more in 2009, and that's sort of the feeling I get right at the moment. So, but yeah, I'm not giving you financial advice. I'm just using my own 20 plus years of experience of when there's chaos, there's opportunity, and that's how it feels at the moment. Anyway, thank you, everyone. Thanks, Selwyn. I appreciate your time, and I'll just see if there's any other questions here, but you're very welcome to jump off, mate.
Thank you. Thanks, Scott.
Cheers, mate. What time on Saturday, Maury? It is, good question. I think it's 8 a.m. South African time, so it'll be 6 a.m. London time, so that people can still, and it's about 4 hours, so it'll finish around lunchtime on Saturday. I think Selwyn inspires confidence in the product, and Calio, thank you. Yep, I completely agree. Look, the man has a PhD from Cambridge in mathematics, so I think he's going to do a little bit more about due diligence than you or I could. And thank you to all the kind messages. Okay, ladies and gentlemen, I think that's everything. I'm going to sign off. Hopefully, you can go to the platform, you can read all about it, and we will let you know as soon as possible. Hopefully tomorrow, as long as we get the Lemonway tick. They've just got to do the KYB, which is Know Your Business, for the SPV to open the wallet, and then we can literally start the transaction. As soon as we have it, we'll let you know via WhatsApp, via SMS, via email. Have a wonderful evening, and I hope you're as excited as I am about these new deals on the Wealth Migrate platform. Good night.